If I told you that the global financial system is built on a foundation of debt so immense that it can no longer be paid down, only rolled forward indefinitely, would you believe it? Most people assume that government and corporate debt eventually gets resolved, that economies cycle through expansion and contraction, and that bad decisions eventually get corrected. But the modern financial system has reached a structural state where the debt itself has become the mechanism that sustains growth, employment, and stability. We're not talking about a temporary crisis or a problem that will resolve itself over time. We're talking about a fundamental shift in how money works, how value circulates, and what happens when an entire system's survival depends on perpetual borrowing. This is not speculation or doomsaying. It's the documented reality of global finance in 2025. Understanding this changes how you should think about savings, investment, policy, and the future. The global debt burden has reached approximately $300 trillion. Let that number sit for a moment. $300 trillion. To put it in perspective, this exceeds global GDP by a factor of 3.5. The world produces roughly $85 trillion in goods and services annually, yet the debt outstanding is more than 3 times larger than that annual output. This isn't a new problem that appeared overnight, nor is it an accident. It emerged gradually through decades of policy choices, structural changes in capitalism, and the deliberate use of debt as an economic management tool. The composition of this debt is important. Roughly $90 trillion resides in the United States, government, corporate, and household debt combined. The European Union carries another $60 trillion. China holds perhaps $50 trillion across government, corporate, and shadow banking sectors, though the actual numbers remain opaque. Japan, despite its reputation as a developed economy with a large public debt, contains another $30 trillion. The remainder is distributed across the developing world, emerging markets, and the shadow financial system that nobody truly measures, but everybody knows exists. What matters more than the total size, however, is the relationship between debt and income. For governments, this relationship is expressed as the debt-to-GDP ratio. For the United States, this ratio has climbed from roughly 35% in the 1970s to over 120% today. For Japan, it exceeds 250%. For Italy, it hovers around 140%. These are not theoretical numbers. They represent the gap between what governments collect in taxes and what they owe to creditors. A debt-to-GDP ratio above 90% historically signals trouble. Above 100%, it enters dangerous territory. Multiple countries now reside well beyond these thresholds. But here's where the system becomes paradoxical. Despite these ratios, interest rates have remained historically low for decades. Governments borrow at rates that seem impossible when you consider the risk. A country with a 120% debt-to-GDP ratio should face punishing interest rates that make borrowing expensive and force fiscal discipline. Instead, many governments borrow at rates below inflation. This isn't because lenders are stupid or foolish. It's because the system is structured in a way that makes debt appear safe, even when it's objectively unsustainable. That structure is precisely what we need to understand. The primary mechanism holding the system together is something economists call financial repression. This term describes a set of policies and structures that keep savers and investors locked into purchasing government debt, regardless of its actual return. In the post-World War II era, governments explicitly used this tool, capping interest rates, controlling capital flows, and forcing banks to hold government bonds. Today, the mechanism is more subtle but equally effective. Central banks set interest rates artificially low, making alternative investments less attractive. They purchase government debt directly, reducing supply and keeping prices high. They regulate banks in ways that encourage them to hold government securities. They manage inflation expectations, allowing governments to erode the real value of debt over time. The system pressures capital to flow toward government debt, not because it's a good investment, but because the alternatives are restricted or unattractive. To understand why $300 trillion in global debt is no accident, we need to look at the post-1970s evolution of capitalism. The period from the 1940s through the 1960s was characterized by robust growth, manufacturing dominance, and rising wages. Productivity gains fed directly into worker compensation. Business cycles occurred, but they were relatively moderate. Government debt was manageable because the economy was growing fast enough to outpace borrowing. This changed decisively in the 1970s. The collapse of manufacturing productivity, the emergence of globalization, and the dismantling of the Bretton Woods system created a new economic environment. Real wage growth decoupled from productivity starting around 1973. This created a structural problem. Workers could no longer sustain their living standards through wages alone. Something had to compensate. That something was credit. Households began borrowing to maintain consumption. Governments began borrowing to smooth income and provide public services as tax revenues stagnated relative to expectations. Corporations began borrowing to fund stock buybacks and financial engineering when investment in productive capacity became less attractive relative to capital allocation. Debt became the mechanism that replaced real wage growth. This wasn't a mistake or temporary measure. It was a rational response to structural constraints. If wages can't grow, but consumption expectations remain stable, debt must expand. If public services and safety nets require funding, but tax bases aren't growing, debt must expand. If financial returns from equity and bonds are compressed and capital seeks higher returns, debt and financial complexity must expand. Each of these forces independently would have driven debt growth. Combined, they created an inexorable pressure toward larger and larger debt burdens. The 1980s and 1990s saw the acceleration of this process, accelerated by the deliberate deregulation of financial markets and the globalization of capital flows. Debt exploded because it was profitable for financial institutions and because it temporarily masked underlying economic problems. A worker losing manufacturing income could maintain consumption by borrowing. A pension fund, seeing equity returns compress, could achieve its return targets by increasing exposure to financial leverage. A government facing stagnant tax revenues could maintain social spending by issuing debt. For each participant in this system, taking on more debt was individually rational, even if the aggregate result was unsustainable. By 2000, global debt had reached roughly $110 trillion, measured as a proportion of global GDP. This was already substantially elevated compared to historical norms, but the story wasn't over. The early 2000s brought perhaps the most consequential policy decision of the modern era, the decision to prevent the recession that should have occurred around 2000 by dramatically expanding credit and lowering interest rates. This decision, made by central banks globally and enabled by financial deregulation, created the conditions for the 2008 financial crisis. The crisis itself became a turning point. Rather than allowing debt to be written down and defaults to clear the system, governments and central banks doubled down. They flooded the system with liquidity, purchased bad assets, and created new mechanisms to keep large debtors solvent. Japan had tried this approach through the 1990s and early 2000s, with limited success in generating real growth, but complete success in preventing systemic collapse. Now, the entire developed world adopted this model. The 2008 to 2020 period saw unprecedented debt expansion. Government debt nearly doubled. Corporate debt expanded dramatically. Financial institutions' leverage reached new highs. The COVID-19 pandemic accelerated the process still further. Governments injected trillions in support. Corporations borrowed cheaply to shore up balance sheets, and households accumulated excess savings while taking on less personal debt. When inflation emerged in 2021 and 2022, the debt burden became even more apparent. But by then, the system was so debt-dependent that raising interest rates to fight inflation became economically dangerous. Central banks faced an impossible choice: allow inflation to erode debt, or raise rates and risk financial instability. They chose the former, raising rates more slowly and less aggressively than historical precedent would suggest, a choice that extended the debt problem into 2025. This brings us to the essential insight. The system can no longer genuinely reduce debt. This isn't a moral claim or a statement about what should happen. It's a structural analysis of what the system is capable of doing given its current configuration. To understand why, we need to think carefully about what debt reduction actually requires. Debt reduction at the individual level happens when income exceeds spending and the excess goes toward principal repayment. This requires either rising income or falling spending. Debt reduction at the system level requires the same thing on aggregate, but the global system has structured itself in a way that makes both of these outcomes catastrophic. Consider what would happen if governments tried to achieve primary budget surpluses, a state where tax revenues exceed spending before interest payments. This is theoretically the path to debt reduction. But governments face immediate pressure. Cutting spending or raising taxes depresses growth, which reduces tax revenues and increases demand for social support. Economic weakness can spiral, creating a fiscal multiplier effect where austerity actually worsens the debt-to-GDP ratio by shrinking GDP faster than debt can be paid down. This is precisely what happened in Southern Europe after 2010, where austerity deepened recessions and left debt-to-GDP ratios even higher. More fundamentally, however, the entire global system is built on the assumption of continuous expansion. Pension systems expect returns. Insurance companies price policies based on investment yield assumptions. Financial institutions value assets based on expected growth rates. If growth actually fell, which would be necessary for real debt reduction to occur, the entire valuation structure of global finance would collapse. A pension fund that needs 7% annual returns cannot operate in a 3% growth environment. It will have to make promises it cannot keep or take excessive risk seeking returns. Either choice destabilizes the system. The same logic applies to corporate debt. Corporations borrow based on assumptions of future growth and profitability. If the system actually contracted, default rates would skyrocket. But corporations can't reduce debt without contracting investment and employment, which contracts growth further. The system becomes self-reinforcing in the direction of expansion or stagnation, but contraction becomes existentially threatening. Households face similar dynamics. Consumer debt expanded because it enabled consumption smoothing during a period of wage stagnation. If households tried to pay down that debt, they would reduce consumption, contracting the economy, reducing employment and wages further. Housing debt is particularly severe. Most household net worth is in housing, and housing prices depend on continued expansion of mortgage debt. If that debt contracted, prices would fall, wiping out the equity of current homeowners and reducing collateral for future lending. The central banks understood this dynamic intimately. In 2008, when they had the choice between allowing debt to default and contracting the system, or preventing default and allowing debt to expand, they chose expansion. They could see that contraction meant depression. Since then, every time debt stress has appeared in 2011, 2015, 2018, 2020, and throughout 2023, central banks have responded with the same solution. Lower rates, inject liquidity, expand their balance sheets. The pattern is consistent because the underlying constraint is structural, not cyclical. What this means in practice is that the $300 trillion in global debt will not be reduced through the mechanisms that debt was traditionally managed: earned growth, primary surpluses, and real repayment. Instead, it will be managed through a combination of financial repression and inflation. Financial repression keeps savers locked into holding debt at returns below inflation, gradually eroding its real value. Inflation itself erodes debt faster than nominal growth can expand it, allowing debtors to repay in cheaper currency. Both of these mechanisms are already in place and operational. They don't require dramatic policy shifts or conspiratorial coordination. They are the natural response of a system confronted with unsustainable debt. The system is also adapting to ensure this continues indefinitely. Central banks have expanded their mandates and tools. Negative interest rates, once considered impossible, are now normal in major economies. Yield curve control, where central banks target specific interest rates at specific maturities, has moved from theory into practice. Quantitative easing, the purchase of government and corporate bonds to inject liquidity, has become a permanent tool rather than an emergency measure. Credibility constraints that once limited how much central banks could expand have eroded as the alternative, allowing deflation or default, became politically unthinkable. This is not sustainable in the sense of continuing indefinitely without cost. The cost is chronic inflation, financial repression on savers, severe wealth concentration as assets owned by debtors appreciate while cash savings are eroded, and structural stagnation in growth as the system allocates ever more capital towards servicing debt rather than productive investment. But it is sustainable in the sense that it can continue for decades without outright collapse, because the alternative, allowing debt to actually contract, would be more immediately destructive. What we are examining here is not a crisis brewing in the distance, but a structural reality of the current global financial system. $300 trillion in debt is not a problem to be solved, but a permanent feature of how money circulates and value is created in the modern economy. The debt cannot be paid down through the mechanisms that historically reduce debt. It cannot be reduced through growth when growth itself depends on expanding credit. It cannot be reduced through austerity when austerity shrinks the denominator faster than it shrinks the debt. It can only be managed through perpetual refinancing, financial repression that locks capital into returning below inflation yields, and inflation that erodes the real value of obligations over time. This system has real consequences. Savers holding currency or low-yielding bonds transfer wealth to debtors and asset owners. Workers in high-debt countries experience stagnant real wages as central banks prioritize financial stability over growth. Financial systems become more concentrated as large institutions become too big to fail and therefore too important to constrain. But these consequences aren't tragic accidents or policy mistakes. They're the logical outcome of a system that chose expansion over contraction, stability through inflation over stability through adjustment, and perpetual debt growth over debt repayment. Understanding this distinction between crisis and structure, between problem and feature, is essential for thinking clearly about financial futures. The system won't collapse because it's restructured itself to prevent that outcome. It will persist, adapt, and continue forward. But at costs distributed unevenly across different groups and assets. That's the reality embedded in $300 trillion of global debt. If you want to understand how these forces will shape your financial future and the broader economy, subscribe for more in-depth analysis of the systems that structure our world.